makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, we have some very big interviews ahead, including the chief executive of the Italian investment bank Mediobanca, as well as the chief executive of GSK and chair of the Fleming Initiative on their partnership to tackle antimicrobial resistance. Now, the Fed chair, Jay Powell, says recent data is giving officials more confidence that inflation is moving towards the 2% goal. While speaking with Bloomberg host David Rubenstein, Powell highlighted the three latest inflation readings, but did not provide clear timing for a possible cut.
On inflation, in the first quarter, we didn't make any more progress. The second quarter, actually, we did make some more progress. We've had now three better readings, and if you average them, that's a pretty good pace.
Now, from on all of this, we're joined by Hugh Vance, Vice Chair and Partner at Oliver Wyman. He's also advising the new UK government's task force to establish a national wealth fund. So, Hugh, as always, thank you so much for joining us. There's so much going on. It's politics in the US. We have now, a vice president pick for President Trump. There's a lot of talk about private credit. The UK, we have a new government that really kind of set its eyes on that growth target. What do you see as unnerving in the markets right now?
Well, thanks for having me on again, Francine. Look, certainly looking at the financials, there's not an awful... The environment looks really reasonably benign still. There's obviously a lot of nervousness about interest rates go next, but we've been debating that ad nauseum. I think the environment looks still very benign. For all the bank CEOs I talk to, credit quality remains reasonably good, a bit lackluster. Loan growth's a bit slow, so they're all thinking about optimising their balance sheets. And so one of the reasons why private credit comes up so much is if they're dieting, someone else is binging, and it's private credit who's benefiting. Yeah,
do you have any concerns about private credit? I know, we had a roundtable recently with a lot of the big people involved in private credit really pushing back to the idea that, first, it's very difficult to value, there could be a little bit of frothiness, and you don't know where it ends up in 2-3 years from now.
Yeah, so I think we need to distinguish between two things, like, is it of a systemic risk? It's too small, it's not leveraged, it's in solid hands. But, will the jump in interest rates have an impact on some businesses? Absolutely. What you can see is that it's most for cyclical businesses, some of the retailers where credit quality is getting a bit raggy. But this is going to be modest. But look, the more that private credit grows, the more that the pricing conventions, the transparency needs to improve. And so bit by bit, we are going to get more transparency, I think, into this market.
How big do you see it being? There are some conservative estimates that it's valued at 1.7 or even 2 trillion at the moment, but This could grow exponentially. Well,
so we just did a deep dive research, and we thought it's probably nearer 3 trillion already, because the Preqin data, which BlackRock just bought, doesn't include direct mandates. So if an insurer directly gives it to a private credit firm, it's certainly based on what we currently see. Could it double over the next 5 years, so grow 15% per annum? That looks likely. At the moment, private credit appears in almost 3 blocks. There's the kind of leverage finance, which is a bit slow because of deals that you're talking about regularly. There's mid-market lending, which continues apace. But the next leg is around asset-backed lending. And the private credit probably only has about a 5% market share in the States, probably less than 1% in Europe. So that's the off-piece territory that they're looking to go into.
Hugh, David Rubenstein had this wonderful interview with Jay Powell, who wouldn't really commit or pre-commit to cutting in terms of timeline. But if the next move is down, is it one and done? And what does that mean for private credit and some of the debt surrounding it?
Well, look, I'm minded I share sort of Torsten Slock's view that probably there might not even be a rate cut this year. And certainly the banks and the private credit firms I'm talking with at least are looking for a range of outcomes. But assuming that maybe there's only one, it certainly would help if interest rates come down. It does help at the margin because 1 or 2 of those raggy borrowers who are looking a bit, would then start to improve. That doesn't mean that gets them out of jail. But, it's about the credit impulse. And so what does either the new administration in the States and also in the UK and across Europe, what do they do for growth? And at the end of the day, banks and private credit are geared players on growth. And so actually it's what happens to that.
Hugh, let's get a briefing on what's happening in the US, and we'll talk a bit about the Labour Party here in the UK. Now, Donald Trump has named the venture capitalist turned Ohio Senator JD Vance as his vice presidential nominee. Now, the two appeared together at the Republican National Convention, Trump's first public appearance since the assassination attempt at the weekend. Now, speaking to Fox News in Milwaukee, Vance signaled a hawkish stance on Beijing if elected.
I think what President Trump has promised to do is go in there, negotiate with the Russians and Ukrainians, bring this thing to a rapid close so that America can focus on the real issue, which is China. That's the biggest threat for our country, and we're completely distracted from it.
Now let's bring in Bloomberg's Flavia Cross-Jackson, who oversees all of our government coverage across the world. Flavia, thank you so much for joining us. What does this appointment of JD Vance actually tell us about what President Trump is thinking? Is he trying to get votes, or does he think he's got this?
I mean, he thinks he's got it, right? I mean, if you saw what Trump 1.0 was like, get ready for Trump 2.0. It's going to be bigger and badder. And Trump is sending a very strong signal by naming JD Vance, who on the foreign stage, on foreign policy, international affairs, is even more extremist than Trump himself. He's the most isolationist person in what would be a Trump White House if Trump indeed wins the November election. And the bets on that really seem to be that, you know, after events of the weekend, the tide has really turned in Trump's favor.
So what does that mean for the rest of the world, Flavia? If Trump and Vance get into the White House, is it disaster for Europe? And what does it mean for Ukraine?
Yes. I mean, one European official privately told me that he would see this as absolutely disastrous. I mean, if you're sitting in Paris, in Rome, in Berlin, or in London, you're thinking, you know, this is the type of presidency that will leave Ukraine up and dry. Vance has been very, very clear. He was very against the bill for Ukraine aid, even when the tragic events happened in Ukraine, where there was a bombing of a hospital and lots of kids died. Vance's response is very clear. We're sorry, but we know we're no longer writing blank checks. So that really gives you an impression of what Vance and the Trump presidency will be like. And of course, if you're in Beijing and you're thinking, well, Trump might actually not come and help Zelensky at all, or if you're Putin and you're thinking, I just need to hold on till January, Beijing is thinking, well, maybe this might be the time to have a crack at Taiwan. So there's lots of repercussions, and lots of diplomats all over the world at the UN and in Washington and embassies are really taking this very seriously.
So I don't know whether we need to start, or whether leaders across the world will start thinking, can they actually Trump-proof their economy? And at the end of the day, what this means for China. Okay, I think we'll get back to Flavia in a second. We're having a little bit of connective issues. Flavia Cross-Jackson there, our executive editor for EcoGov, EMEA, and Latin America. Now, still with us, Hugh Van Steenis, Vice Chair and Partner, and Oliver Wyman. Now, he's also advising the new UK government's task force to establish this National Wealth Fund. Without going too much into US politics, Hugh, I mean, if you're Keir Starmer, you've been into the job for 10 days, you're trying to, you know, do things on a multiple fronts, especially this National, of course, Wealth Fund. I mean, how do you deal with the Trump president?
Well, I'm not sure I'm the best person to advise on that, given my bailiwick. But I think it's going to be around being very open for business. You know, at the end of the day, one of the biggest challenges the UK has is to reboot foreign direct investment. And at one level, actually, from my conversations, some of the private equity firms are really sniffing around and doing the work around UK stocks again. And that's partly post-election. And there's a really big spike in sort of due diligence type work. But I think if we think beyond this, how do you get foreign direct investment? Now, the National Wealth Fund, it's interesting, it's the first big announcement the government made, or the Chancellor made. And I think it's partly to try and signal we're open for business and particularly want to attract jobs and...
Hugh, just so that people understand, I mean, this is not necessarily like UK money, right? This is like a concierge service that says we're open for business. So if you're a Blackstone, if you're a BlackRock and you want to invest, you know who to pick up the phone to.
Oh, no, I think it's a little bit more than that. So they've earmarked £7.3 billion, so, you know, just over $10 billion, to invest in early-stage businesses and projects around, you know, carbon capture, new batteries, kind of sort of what the IRA is trying to simulate in the States. It's obviously a mini-me versus IRA, but it's comparable to, let's say, in Canada, there's a Canada Growth Fund. It's about a $15 billion fund. And actually, it's very similar in terms of trying to seed new jobs, seed jobs of the future. So I think it is open, but obviously at the heart of it, they're trying to get $3 of private sector money to $1 of government money. So it's very much trying to catalyse investment in the UK.
And again, is there a timeline concern, or how quickly does that money have to come to make sure that they hit that 2.5% growth target?
Well, obviously, your colleague Catherine Griffiths wrote that they're hoping to get this announced, the next stage of this announced by a global investment summit in the early autumn. And I think, you know, again, trying to have a bigger global investment summit, like Macron had, like obviously, quite early on, is trying to signal to international investors we're very much open for business. Look, in terms of the 2.5, there are no easy fixes here, are there? I mean, I think that we've debated before how to improve better relationships with Europe, how is the best way to do that. Great, but, building confidence and showing that there is a sensible government with long-term policies, that can only help.
Hugh, do you think the best quality of the UK right now is being fairly steady, actually, given, some of the politics in France and the US, that maybe investors see it as a stable place to park their money?
Yeah, so and I was speaking at an investor conference last week, and actually there was a poll. It was very clear that many of the fund managers had flattened their investment in France, flattened their investment in Germany because of lacklustre growth. Actually, Italy still stands out, as I'm sure Alberto will say, but actually many other places look quite volatile across the continent. And so actually the UK is looking, has been very cheap. And let's go back to it. On the Goldman's research, UK banks are the second best performing subsector in Europe, only after defence, with European banks number 3. So there's this kind of, actually they've performed better than all of the FANGs except Nvidia. So I think actually there is already a re-rating, but I suspect there's a bit more to go in the UK.
Hugh, thank you so much, as always, for joining us. That was Hugh Vance, Vice Chair and Partner at Oliver Wyman. Now, coming up, our exclusive conversation with the Chief Executive of Mediobanca, the biggest publicly traded investment bank in Italy. We'll discuss the M&A pipeline, IPOs, and, of course, banking consolidation. That's next, and this is Bloomberg. Now, welcome back, everyone. The deal pipeline for investment bankers is looking a lot healthier. Now, the global volume of M&A deals announced in the first half of the year is more than $1.4 trillion, up around 14%. That's according to Bloomberg data. Now, amongst the headlines, we've seen BBVA's hostile $11 billion approach for Banco Sabadell in Spain. Well, my next guest is one of the few investment banks to have acted as an advisor on that bid, as well as the $22 billion deal for Telecom Italia's network. Well, Mediobanca is Italy's biggest publicly traded investment bank, and it's seeking to also build out its wealth management unit to bolster growth. Well, joining us now for an exclusive conversation is the company's chief executive, Alberto Nagel. Alberto, thank you so much for joining us. As always, I love speaking to you because you give us a good glimpse of actually some of the inners and goings of the banking world. Are things picking up? Are you seeing more transactions, whether hostile or not?
Thank you, first of all, Francine, for having me today. Yes, we see definitely more activity. This is on the back of more favorable environment already in 2023, with more favorable conditions for financing, which is key to push M&A. So M&A has seen in Europe an increase of 45% in terms of volume year to date, and this is both on strategic large transaction, the one that you mentioned, but also private equity. While in mid-corporate and smaller transaction, a fewer number of announced deals, but I think this mood can be consolidated in positive in the next few quarters because we see an intake of new mandates coming in. And this can be also fueled by a further decrease in interest rates and the stabilization of the markets.
But Alberto, do you see private equity as an asset class that will just keep on growing and growing? I spent a lot of time with private equity titans that say, we are the future, this is where it's going to go, it's private credit and the like.
For sure. You have to imagine that the private equity are among the biggest fee payer into the market. They have amassed a big capital in terms of new money coming in. They have to sell assets and they have to invest the money that they have collected. So they will be a key driver for the industry for a long run. So
what does it mean for Mediobanca? I know you're also targeting wealth management. How big, if you look at some of your targets that you've put in place, are they all in line with what you're expecting, 6% in terms of, for example, wealth management as a top contributor?
Yeah. We are in the implementation of our plan. This is our first year, and we are more than happy with what we have been achieving. Why? Because basically we set an important target to evolve Mediobanca into a wealth management and operates it with a model we call it private and investment banking model. No? Why? Because Mediobanca has always been close to family in Italy, large family having large cap. In the last 10 years, we have invested a lot also in mid caps. So today in Italy, to grow in private banking, you have to be close to events. The events are the opening up of capital of mid-corporates. So if you have a powerful investment bank that has strong relation with the families, then you can be there when events are happening, because also you manage those events. And so you are very close to be the possible wealth manager of their wealth when they come in.
I think you also never, shied away from talking about possible small bolt-on acquisitions. Do you have a treasure trove, and what segment of the market would you be looking at?
Well, the second pillar of our strategy is to evolve also not only our wealth management to become much bigger, which is happening, but also to evolve our model of investment banking in a way that is to be considered more advisory driven. And in this, we have targeted two main sectors. One is digital transition, and we have done this partnership with Arma Partners, which is a leading boutique in digital advisory, which is outperforming the European market as the biggest team in Europe. And this is one driver of growth. The second is energy transition. We have announced three of the most important deals in Europe, in Southern Europe. So these two basically sectors, together also with mid-corporate and private capital, as I said before, are the key driver of evolving our investment banking to capital-light fee-based.
Is there a country that is more appetizing than others? I think you've also opened an office in Frankfurt. But given all the political turmoil, be it in the US or France, is there a danger that your short-term strategy has to be readjusted?
I don't think we have to readjust, because basically, as we said, M&A and the dynamic of mid-corporate in Europe will be such, even in the medium term. So we will see a lot of transition from family-owned company, entirely owned by family, to family where private equity are playing a good role, either to grow, to list, or to recap. So this is going to be a theme for the future. So becoming an important player in mid-corporate as well in the most important connected economy to Italy, so France, Spain, Portugal, and Germany, will reinforce our model and is an evergreen. So there can be cycle, but this is going to be a trend.
But Alberto, private equity is actually changing quite significantly, because they're buying companies and then holding on to them for a much longer cycle. Do you see that changing their business model and changing your business model?
Well, it's more cyclical. The fact that they're holding for longer also depends on price expectation and entry price. Yes. There will be an adjustment. They will take an adjustment and move on. We see private equity enlarging a lot their spectrum in a number of asset class. From pure private equity LBO, they are becoming a credit operator, they are becoming real estate operators, so they are expanding a lot.
Yeah. I've known you for at least 10 years, and every year I ask you, is there going to be cross-border consolidation amongst the banks?
Well, Francine, everybody speaks about consolidation in Europe, in banking consolidation, but this hardly happens. Why? We need to focus on the obstacle and remove the obstacle. There are, I would say, political and technical obstacles. Political obstacle because there are still some banks in Europe owned partly by government where local interests are prevailing. So they are always saying, okay, we are favorable to consolidation, but when you go and ask for disposal of the stake, you understand that it's better to find a national solution rather than a cross-border solution. Then there are technical issues we can work on, we should work on. So I mentioned some. In a moment of higher interest rates, you have long-dated assets that have to be marked down when it comes to merger accountability, while the liability are not going to be, reevaluated. So this is something that should be reconsidered. GFI buffer is another issue. So there are some big banks in Europe that are not big banks in reality worldwide that have GFI buffer that is too big. And we need to rethink about those GFI buffer also with AT1.
That's another. We have to get you back on to talk about AT1. We could talk AT1s for about 2 hours. Alberto, as always, thank you so much for joining us.
Thank you very much for having me.
Alberto Nagel there, the Chief Executive of Mediobanca. Much more to come. This is Bloomberg. Welcome back, everyone. There's quite a lot of movement when it comes to luxury stocks. Hugo Boss slumping after the German clothing producer lowered its full-year outlook, citing the impact on demand from persistent macroeconomic and geopolitical challenges. Now, the other story is Richemont posting a slight rise in sales in the first quarter as solid results from its jewelry brands actually helped offset declines from China and its luxury watchmakers. Coming up, we talk healthcare and healthcare science, the urgent fight against drug-resistant superbugs. We hear exclusively from pharmaceutical giants GSK chief executive on its partnership with Imperial College London. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Donald Trump picks Ohio Senator JD Vance as his running mate, a populist protege seen as a rising star in the Republican Party. Jay Powell says recent data raises confidence that inflation is on the path to the Fed's 2% goal, reinforcing bets that rate cuts are indeed coming. And Richemont's resilience. The Cartier owner posts a slight rise in sales in the first quarter as solid results from its jewelry brands actually offset declines from China. Now, on to health matters, and the UN is warning that the number of novel antibiotics being developed to fight drug-resistant superbugs remains, quote, woefully insufficient, despite the organization estimating that they could cause up to 10 million deaths a year by 2050. Now, the pharmaceutical giant GlaxoSmithKline has pledged £45 million to a new initiative being led by Imperial College London to tackle this global challenge. Now, for more, I'm delighted to be joined by the GSK Chief Executive, Emma Walmsley, and the Director of the Institute of Global Health Innovation at Imperial College London, Professor Ara Darzi. So thank you both, Lord Darzi, and, of course, Emma, for joining us. There's so much going on in the world that I think this has really taken a bit of a backstep. Is this because COVID has made us focus on a lot more pressing issues, and so antimicrobial resistance is just not at the forefront of people worry about?
Well, first of all, I think, Francine, you're absolutely right that there is not enough understanding of the very serious and imminent threat of antimicrobial resistance. More than 1 million people die every single year, and it's not just in developing countries, and that is going to accelerate to more like 10 million by 2050 unless we bring forward not only new innovation, but great stewardship and improved policy. So the threat is not sufficiently understood. No. We urgently need to innovate more and incent that innovation. And most critically, which is why we couldn't be more thrilled to be supporting the Fleming Initiative, we have to do this in partnership with governments, with policymakers, with regulators, with the general public, but also with healthcare systems and prescribers too. So there's a lot of work to do, and it's so important that it is brought up in public awareness. And so,
Lord Darzi, where's the problem? So this is basically something that's, your life's work, especially at the Fleming Institute. Is that, are we prescribing the wrong antibiotics? Is it that we don't finish the courses as the doctors say? And why is this also a problem in our hospitals here in the UK? This is not something that's, further afield.
Absolutely. The big challenge here is the misuse and overuse of antibiotics. And as we misuse and overuse of antibiotics, bacteria have been able to develop resistance to the current antibiotics available to us. So we get infections now in which we don't have an antibiotic to treat them with. But thanks to GSK and some of the innovation pipelines that are coming through will help us with this. Why now? We're doing it because we're approaching the centenary of the discovery of penicillin, which in 2028. And if I could just give you one little figure, in 2028, there'll be more people dying of antimicrobial resistance than people died in 1928 prior to the discovery of penicillin. Just to give you the magnitude.
Crazy, but people don't realize.
Absolutely, and don't realize that. And that is why the big component of this multi-sectoral approach to this problem is not just science, it is actually engaging citizens globally through programs like this. We need to activate citizens that the misuse of antibiotics, either in human health or animal health, may I just say, it's not just human health, could actually have a serious detrimental effect on the efficacy of antibiotics when you're ill, when you really need them.
Is there a quick fix? I mean, this is, of course, is research, but is it, up to doctors and vets to prescribe them less, or is it up to the public to basically finish their courses?
Well, it starts with making sure that we have a good pipeline of innovation to address some of these resistant pathogens. And at GSK, I'm pleased to say we have a very proud history in antibiotics. In fact, when you look back, we provided 80% of the UK's penicillin during World War II. We have 30 assets in our pipeline. A lot of focus on vaccines, because remember, one of the most important moves we can make is prevent some of these diseases from taking hold and needing scale treatment of antibiotics. But we're also, in our pipeline, addressing, I think, 12 of the WHO priority pathogens. And these are, frankly, really simple but prevalent diseases like urinary tract infections, gonorrhea, Salmonella, Shigella. These are diseases that can become really life-threatening if they're allowed to progress. So we need the innovation. Yeah. We absolutely have to get the stewardship, which means better surveillance, a real understanding, an investment in diagnostics as well. So we're prescribing the right antibiotics to people that need them, and this public health awareness of completing courses efficiently. So I think this is not a quick fix. It requires sustained investment and it requires deep partnership, which is why the work that the Fleming Initiative is doing, anchored in the UK, but with an intent to have global outposts and multiple partners, is so important, and we are delighted to support it.
To be honest, it's surprising, actually, because to get any NHS doctor to prescribe anything in this country is so hard, right? So you kind of wonder what it means for other countries where they prescribe antibiotics more liberally.
I agree with that. I mean, we are absolutely delighted with the partnership with GSK. I mean, GSK is one of the few pharmaceutical companies in the world that has 33 new innovations coming in the pipeline. This is not an area that Big Pharma is looking at and investing. Thank goodness to the AMR Action Fund and other organizations. The other missing bit here is diagnostics. You have to appreciate that 70% of prescriptions in the United Kingdom, given to in Europe, given to patients, are without a diagnostic test. There is no other disease in which you receive therapy without getting a diagnosis.
Because it's expensive.
Absolutely. If you go to lower and middle income countries, by the way, you don't even have a GP or a doctor. So you go to a chemist and you have 4 antibiotics. And if your bug is resistant to one, those 4, you're in real serious trouble.
I mean, I was in India last week and Africa earlier in the year, and this question of getting the right antibiotic for the right disease with the right diagnosis is really, really critical. We just launched purely a data surveillance program called the India Infection Initiative, and where we just bring localised, not just national, but local susceptibility data to different pathogens. And we're already getting 70,000 healthcare professionals just consulting it to understand the right way forward and within the guidelines for prescribing.
Why do you think it slipped from public attention? Again, I don't know whether, the numbers are there, but I don't know whether it's kind of like, pushed back because people don't see it as
like it's hard to invest in preventative care that's not front of mind. Healthcare systems around the world, including here at home, are under enormous pressure. And this is something that is about looking forward. Lots of comparables to everything that's going on the global climate crisis, where we're investing in the future and preventative care. But the time is now, because it's becoming really very urgent and it's not a quick fix.
And could I just add the 2 other value propositions beside the science, which is absolutely critical, is engaging citizens globally in this debate, understanding what this is all about. A bit like climate in the 1990s. Academics were speaking about climate change. The public were completely switched off. We need to engage citizens. And by the way, it's the Bloomberg's activity that engages public and changes behavior. That's a critical component of this. And then the third one, which is even more important also, is policy and regulation. Could we prescribe without a diagnostics? One example. Regulation. Could we label food which has been treated with antibiotics to the consumer?
I guess it just feels far.
Yes.
This is a problem, is that how do you bring that closer to people understanding? Unless you have bacteria that's resistant to antibiotics, people won't necessarily engage with the debate.
We're starting that engagement now. We're starting at schools. We are engaging schools, kids, to educate their parents. We're really engaging not just beyond health, in mass gatherings. How do you manage infections? And that's the value proposition of this tripartite mission of the Fleming Initiative, which, as Emma said, is not just in the UK, by the way. We're going to have a centre in one of 5 continents around the world, one in Africa, one in Asia, because this is a global issue. It's not a local issue.
Are policymakers and politicians listening on this here in the UK?
Well, I think I think the UK has led the way, not least with the Fleming initiative, but also we're seeing progress in fundamental policies. Because the real challenge for the industry, of course, is when you want good stewardship and extreme discipline on prescription, it's hard for the industry to see when we are working with IP and a program where we're constantly having to replace our business to see really big scale returns on investment in innovation. So the UK is leading the way, actually, in looking at new incentive systems, for example, a subscription program, perhaps a flat fee for an innovation that you can keep in a cupboard, not overused, not overprescribed, but that will save lives in this resistant environment. So I think it does need innovation, not just in products, but in policy, to make sure that effective solutions come through. But again, it's not just the products that we can invest in developing. It's also a big question of governance, of surveillance, of tracking, and you know, a lot more work to do. But I think the government are making progress.
Are the pharma companies, you know, present company excluded, part of the problem? Is that they're trying to push antibiotics to the people?
I would say I think the industry has a lot to be proud of on raising awareness here. Whether it be through the Antimicrobial Resistance Action Fund, which actually was pledging an enormous amount of funding for venture capital to invest in new solutions, or building awareness since 2016 when it was first put on the UN agenda. I think there's more to do, for sure. And I'd love to see more people investing in and partnering with the Fleming Initiative, but I think UNGA that's coming up is going to be an important moment to raise our voice together as policymakers and industry.
Does the US have it easier with the Inflation Reduction Act because it's easier to develop some new drugs?
I mean, Emma will answer that. I think there are certain incentives there, but at the end of the day, not many people are doing this, thanks to GSK, and many hopefully will join this battle against AMR.
So we have a new government. You're committed to London. You also have a new headquarters in central London.
Just opened yesterday. So.
Congratulations.
Yeah, I'm very excited about that.
What are you hoping to get from this government in life sciences?
Well, first of all, fundamentally, Francine, I'm optimistic. And a new beginning with a significant majority on the subject of healthcare, which is frankly quite a bipartisan issue. I think we should be ambitious for scale change, a bit patient, because this is going to take time, but GSK certainly stands ready to partner. Why I am feeling really quite positive about this, I think everyone now recognises the direct link between the general public's health and the health of the economy. And I think that what Wes Streeting is seeking to do with the NHS, I have huge empathy, by the way, not least with support from ARA, but huge empathy for prioritising patients and the workforce, but also saying this is a country that wants to lead the way in terms of scientific innovation, investment in R&D, and we certainly stand ready to partner with that, with the government, with regulators, and we need this country to be competitive because we want to incent FDI here, not just from GSK, that is a UK company, a proud UK company with our HQ here, investing more than £1 billion a year with 11,000 people, exporting 6 billion of products around the world. But my goodness, this field is competitive, and I think we can be optimistic and constructive in the path ahead.
And are you also confident in life sciences, but also education?
Absolutely. May I just talk about the bipartisan? I mean, David Cameron was the person who brought AMR to the G20.
Absolutely.
In his day. Let's acknowledge that. Subsequently, Tony Blair, Gordon Brown have been unbelievably supportive to this, and Keir Starmer would be. And we're really looking at exciting opportunities to really deal with this global health seriously.
Thank you both for joining us today. That was GSK Chief Executive Emma Walmsley, Imperial College London Professor and Fleming Initiative Executive Chair Ara Darzi. Now, coming up, we go back to politics and talk a little bit about interest rates. Jay Powell tells us recent data has been encouraging, so we'll have more from our interview with the Fed Chair next. This is Bloomberg.
The labor market remained very strong, unemployment remained very low, and inflation came down at quite a sharp pace, particularly in the second half of the year, by a very large amount. And that forecast was almost unheard of. It was unheard of before 2023. So big upside surprise that year. This year, we had expected the economy to slow a bit gradually, the labor market to continue to gradually cool off after being overheated a couple of years ago, and inflation to continue to make progress. And something like that is basically what has happened. The economy is growing now at about 1.5% in the first half of the year. Most forecasters have about a 2% growth rate for the full year. The labor market, again, has moved into better and better balance to the point where I think you can now say it's essentially no tighter than it was in 2019 before the pandemic. Remember that the labor market of 2019 was a very strong labor market. So we're back to that place, no longer overheated. On inflation, in the first quarter, we didn't make any more progress. The second quarter, actually, we did make some more progress. We've had now 3 better readings, and if you average them, that's a pretty good pace. So turning to policy, your question, what we've said is that we didn't think it would be appropriate to begin to loosen policy until we had greater confidence that inflation was moving sustainably down to 2%. We've been waiting on that, and I would say we didn't gain any additional confidence in the first quarter, but the 3 readings in the second quarter, including the one from last week, do add somewhat to confidence. We've also said that we're a dual mandate bank. For a long time since inflation arrived, it's been appropriate to focus mainly on inflation, but now that inflation has come down and the labor market has indeed cooled off, we're going to be looking at both mandates. They're in much better balance, and that means that if we were to see an unexpected weakening in the labor market, then that might also be a reason for reaction by us.
Okay, I think I understand. So to put it in terms I can for sure understand, the markets are suggesting, the futures markets, that there's a 90% chance that the Fed will lower its discount rate in September. Do you think the markets know what they're talking about?
So today I'm not going to be sending any signals one way or the other on any particular meeting. So just to ruin the fun right at the beginning. I simply, we're going to make these decisions meeting by meeting, and we're going to make them on the basis of the data as they come in, the evolving data, the evolving outlook.
Well, the Fed Chair Jay Powell there speaking with Bloomberg's David Rubenstein at the Economic Club of Washington. Coming up, Richemont defies a drop in watch sales and a slump in China to meet first quarter estimates. So we'll have plenty more from the luxury sector next. This is Bloomberg. Welcome back, everyone. Now, Richemont posted a slight rise in sales in the first quarter as solid results from its jewelry brands offset decline from China and its luxury watchmakers. Now, it follows disappointing updates this week from Burberry and Swatch. Now, for more on all this, let's bring in Andrea Felsted from our Bloomberg opinion team. So we have luxury, and then we'll also talk about the banks with Charlie Wells. Andrea, thank you so much for joining us. I mean, luxury is having a bit of a moment, on the downside. So I don't know whether it's you get punished if you just don't have the right products, or you almost get punished no matter what because China's in a slowdown.
We are really up against the time last year when China was really booming. Remember, we came out of the Chinese lockdowns, and there were hopes that the Chinese consumer would start spending again, and they did for a little while, which is why the comparisons are so tough. It slowed down in the third quarter, but this time last year China was booming, and that's part of the problem.
But is this also because the price points are too expensive? Something like Burberry. So it was a profit warning. The chief executive, decided to leave. They had to get someone new in. Is that because they didn't really quite get the right mix, or is it, a bit of not being lucky because they also were changing the company at a time when there was a slowdown?
I think they were really trying to change a company. They were swimming against the luxury tide. You know, elevating a brand is difficult at the best of times. Elevating a brand when the market is really against you and you get, 40% of your sales before the pandemic from the Chinese, it's really very difficult. I've actually got a slightly different view about Burberry than the market. I think, yes, they did raise prices and they perhaps went a bit too quickly with the price hikes, but I thought the product was good. I thought it was a step on from the previous team. What it never really seemed to get was that cool factor. And that was really the thing that was lacking. Because if you've got an in-demand product, just look at Van Cleef and Arpels necklaces. They cost thousands, but people want them, so they will buy them. And that we just never seem to get there with Burberry.
But so is it, luxury, again, you have different segmentations. Is it jewellery that's doing better than, Chanel handbags at £10,000?
Well, that's interesting because in previous downturns, it's handbags that have outperformed. But this time it tends to be jewellery because handbags have gone up in price so much that you might think, well, shall I buy a Chanel handbag or shall I buy a Cartier Love bracelet or a Van Cleef necklace? And, in previous times there was a big differential, but because the handbags have gone up, there's not so much of a differential. Also, jewellery has become much more democratised. We've had, 10, 15 years of luxury demand. We've been buying it bags for a long time. Nobody starts their luxury journey with jewellery. We build on, leather goods, shoes, bit of fashion, then you move to jewellery. So it's a bit of those sort of, lucky combination of factors that's really making jewellery sparkle.
Unless you're Italian, then you're 5 years old and your godmother gives you something. Andrea, thank you so much. Andrea Felsted there from Bloomberg Opinion. I would read all of her columns because they're never dull and always a little bit outside the box. Now, let's also talk about finance. Goldman Sachs is the latest of the U.S. banks to report earnings, with its trading unit and capital markets business helping to drive better than expected results in the second quarter. Now, for more, we're joined by Bloomberg's Charlie Wells. So, Charlie, we talk luxury, we talk banks. I mean, we're kind of like in the full swing of earnings. We have two big banks expecting. How did Goldman do yesterday?
Look, so they did pretty well, except there was a surprise miss, and that was in M&A advisory, and that has got to hurt because they had a great report card, in almost every other business line, but they were about $100 million in that M&A advisory behind their rival JP Morgan. So that's going to be frustrating for them, and a little bit surprising because the environment has been changing to one where we might assume it's a little bit healthier for M&A.
And so a little bit later today, we have Bank of America and Morgan Stanley. They'll be different. I mean, JP Morgan was another record last week.
Yeah, it really was. And this today is going to be kind of a tale of two banks. So Bank of America kind of straddles Main Street and Wall Street. All eyes there are going to be on net interest income. So management has been saying, that could trough in this quarter, but it could be, better going ahead. And then Morgan Stanley, looking to see if they have kind of a similar dynamic to Goldman.
Great. Thank you, Charlie, for all of the update. And, of course, Charlie will be on this beat throughout the day as we have quite a lot of the U.S. banks reporting this week. And then next, we also have the tech companies. Now, Bloomberg Brief is up ahead, and this is Bloomberg.